Mhm. Good evening, all. So, hope the presentation is visible and my voice is clear, audible. Yeah. So, can anyone respond?
Yes, ma'am. It's clear.
Okay. Thank
Yes, ma'am. Clear, ma'am.
you. Clear. Okay. Thank you. Okay. Thank you, Mazen. Thank you so much for your wishes. Okay. So, yeah. So we are at the third session. That is the final session of risk management. So I think no, like for the last two sessions, we were seeing about what is risk, what it is all about, and no, like how the company organization faces a risk, and what are the measures to be taken, and how they can speculate a risk. So a risk is something or kind of uncertainty which is going to happen in the future that will no like create a no like an effect on the business, not only for the business but for the economy as well. So after analyzing the risk, after now identifying the risk, how the management has to deal with the risk. Not only the management, but like how the management has to train all their employees to deal with the risk which is going to which they are going to face in the future. So this uncertainty of the future. So sometimes it can be certain, sometimes it can be like uncertain. Certain risks or something like according to the business flow. So as per the present business flow, if the same thing is going to continue, so obviously the organization is going to like encounter a particular kind of risk, that is certain risk. Whereas uncertain risk is something where like because of some like unexpected events, some it can be no internal or external. Internal events in the sense it can be like turnover of the employees, or no like bulk absenteeism of the employees, or non-availability of raw materials, or no like the required inventory, or no like stoppage in the or breakdown in the machinery, whatever, for whatever reason, for whatever internal reason. So something unexpected has happened, and because of that, no, the business process has ceased for some time. They couldn't continue the business. And when coming to external factors for the business, which like deals with the risk, that is which makes the organization to face risks, all the political factors, the like environmental, economical factors, like prevailing in the external environment, and the government rules and regulations, and public policies, like and business policies, and many things. Like so, those external factors also create a great impact in like making the organization to face the uncertain risks. So there are certain risks, there are uncertain risks. So what happens? Like if the business has identified the certain risk, they have known that like if they are going to continue with the same process, with the like same machinery or same technology, or with the same like employees or workers, so or with the like a limited resources, whatever they have. So this is what they are going to face in the future. So they have no like options. They can know like they have to change, they have to adapt, and they have to know like keep on moving with like adding up new things, or something new, enhanced things, like in their day-to-day operations, business operations. So something has to be done. Some change has to happen from the organization side, so that the certain risk which has been already speculated, so that can be avoided. When coming to unexpected or like uncertain risk, so many companies would be like be ready for that, because like even though if it is not certain risk, sometimes like companies speculate that because of this reason, in case if this risk happens, so what know how to deal with the risk, or what is the best measures to know like to be taken to deal with those uncertainties. So they know the technology, they know what to do, measures, they know everything. They do have that SOP, like they have it in hand. And sometimes even some uncertain risk, like some things are beyond our control, beyond the business control, or beyond anyone's control, like natural calamities, sudden floods, and like tsunami, or whatever natural like disasters happening. So that cannot be like predicted much earlier. And sometimes like business has to face those uncertain risks. And obviously like there will be a negative impact on the business. In that case, either if the business has like taken insurance for their products or for the business activities or for all the inventory, all the physical components, as well as for the lives of the employees, if they have already taken the insurance, so they can compensate the loss for up to a certain percentage. But on the other hand, if it is not being insured, the Carno organization has not insured for anything, any of its physical components, including the manpower. So in that case, they have to face a loss. But sometimes few governments may come help, like come for helping hand, and they can do their best to like make these industries like survive for some time by like waiving off their loans or by like giving some subsidiaries to them for whatever measures like they can do at that time, they will do. So this is how the organizations they deal with the certain risk and the uncertain risk. So we have seen about like all the types of risk, like whatever the business has faced. And last week I think we have seen the business manage that is risk management tools. Sorry. So how to like manage risk. So there are five major tools. This we have seen: risk control, risk financing, and loss control. That is like how to deal with the loss control and insurance. So under risk control, you have risk avoidance. Either you can completely avoid the risk, or you can reduce the risk to a certain limit. When it comes to risk financing, so you can go for risk retention, or you can go for risk transfer. That is like adding more parties into the business and like transferring few delegations so that like the risk can be like transferred. That is like shared by the other parties as well. So there are two ways for like risk transfer, either by contracting or by hedging. And even like insurance is also that can be also like added under risk financing. The third one is loss control. So if at all the loss has happened, so like how to go with that, or like how to control the loss. And finally the insurance. And I think like then we have seen each and everything like how to go with this. Okay. So now, today, as a final session topic, we are going to deal with, like three topics. The first one being risk evaluation tools or risk identification. Uh, there are like few tools, like for the business organization, that is for the few organizations, to evaluate or to identify, like some certain risk and to evaluate the risk. That is like up to what is the intensity of the risk which they are going to face. So how much is the risk all about? So if they have to know like spend like or give utmost attention to resolving that risk, or like it can be dealt if at all that risk has happened. So whether to take it lightly or to take it so seriously, or no, it can be dealt in a moderate way. So first they have to identify the risk and then evaluate the risk. It is not like up to what percentage or what is the intensity of the risk the business is going to have. So the first tool is the risk mapping. So it's a systematically mapping the risk faced by the company, and it listing all the relevant risks. What are all the like risk a company might be facing, like like uh, a loss in the business. There is no like there is no profit at all, and like high competition. That is a risk, and because of that, there is no sales, and theft, loss of the product or loss of any of the physical component, fire, and damage to the property because of human mistakes or human intervention or like natural intervention. any of these reasons, no, like that is a damage to the business property. And what else could be the risk? So these are no like few risks, no, like the organization may face. So they have to map it, each and every risk, no, whatever the business speculates, they have to map it. And even no like shareholders suddenly no like withdrawing from the company. So no like withdrawing their shares and they are no like going out of the company. That too is a risk. So without any no like prior information, when they immediately no like counter no like decision. So immediately they take the decision and no like if they are going out of the organization, so that too comes under the risk for the business. So all these risks, no like it's mapped in a like it is mapped as a representation. So then after mapping everything, each single risk is placed in a two-dimensional place, that is no frequency and severity. Frequency is how frequently it can happen. See, natural calamities, it can happen only once, not frequently. Unless and otherwise, your organization is located in a area or in a place where no like there are frequent earthquakes or there are frequent floods. So otherwise, no like the natural calamities is not going to happen so frequent. And theft, that's not going to happen so frequently. So in case once a theft has happened, obviously the organization would be no like so seriously monitoring or everything by placing CCTV cameras everywhere and no like checking no like making things no like organizing things in a very secured way. They cannot control the theft thereafter. So that's not going to be frequent. And shareholders. So shareholders suddenly decide, no, they are going to withdraw from the organization. So again, no, like yes, either it can be treated as no like a frequent thing, because when one shareholder no like withdraws, obviously that may no like create a like a butterfly effect, and because of that, other shareholders may also take the same decision. So in that case, it can be frequent, or sometimes no like it cannot be frequent. And then a severity. Severity, no, to which extent, up to what percentage. So that is severity. So under these factors, the risk, no, like all the risks are mapped in a, like as a graphical representation. Location of the risk in the space allows top management to reach a decision regarding which risk should be assumed and which risk should be hedged. So when assuming these risks, no, like you can have an idea about whether to know like spend more time in no like avoiding the risk, taking no like measurements to avoid the risk, or it can be the risk can be no dealt when after it has happened or just before it has happened. So if at all no like it's going to happen, then no like we cannot deal with the risk. So till that time we can relax. So such kind of no like a strategy, or we have to know like immediately know like take preventive measures and everything as in order to know like avoid a risk which is going to cause a severe damage to the business. So no these decisions can be taken. The higher a risk ranks for these qualities, the more threatening it is to the organization. Risk management begins with building a list of all risks in the organization faces. Depending on the industry, that this number could range from a handful to hundreds. So there is a small organization, very hand, no, like very, just handful of risk, no, like it's possible. No, like in case, no, like a multinational organization, a multinational company, or an organization which is no like which has no like established in an extensive way. So in that cases, the risk can be in hundreds. So what is the benefit of this risk mapping? First, see, like how risk mapping, like works out. One second. Yeah, this is how, like the risk mapping is. So it is represented as a graphical, like format. So these things, like these are the risks mentioned here: tornado, fire in warehouse, default on payment, owner's disability, system failure, robbery. The now system failure can be frequent. Yeah, if not proper measures are not taken, the system failures, no, it can be a frequent one. Then job related injuries. Again, this can be a frequent one. And auto liability, vandalism, and petty thefts, small thefts, like that may happen. So few of these things. See, tornado is something which is not so frequent unless and otherwise the organization is like located in a place where frequently the tornado hits, or frequently the flood hits, or frequently earthquake or tsunamis are not happening. So only in that case, these natural risks, so like it would be frequent. Otherwise, it will not be frequent at all. Whereas the other things, like fire and system failure and job-related inquiries and petty thefts, vandalism. So these things, like uh, if at all it happens, like that can be prevented, that can be like minimized or completely prevented, making sure that it doesn't happen for the second time. So this is how the risk mapping is done. This is one of the tools in risk evaluation. Now let's see the benefits. Risk mapping is beneficial because it requires the personnel to assess each risk. That is, each risk is given some, like a weightage, and its causes and consequences individually. It also allows to look into the risk environment as a whole and understand how frequency severities compare. So whether it's going to be frequent, or if it is not going to be, even if it is not going to be frequent, but it happens only once, but the severity is more. The intensity of the risk is like very high. So once for all, the total organization collapses because of one risk, which is not frequent, but the severity is more. So obviously, like you have to take preventive measures, precaution, like everything has to be taken in advance as soon as the organization predicts the risk, that is speculates the risk. But few things, it happens frequently, but the severity is not more. For example, petty theft. Petty theft, like maybe in the warehouse or the production unit, the materials, like very limited quantity. So that is being, like sometimes, like someone takes that in a very small quantity. So that is not going to cause a big effect for the organization, but the frequency can be controlled. If not monitored properly, it would be frequent. Anyhow, it is not going to create like a loss to the organization, but that has to be avoided, but can be treated like in a slow way. There is nothing to panic on that because the quantity is very less, so the cost of the material would be very less, and the effect would not be too much at all. The most severe and frequent risk, that is considered as the primary risk, the very important primary, the first one, are critical and would hinder the ability to conduct the business. So once it happens, once the organization faces the primary risk, so it is like almost done. Okay, so it's very difficult for the organization to come up again. So risks that are severe but unlikely, that is like to detect and monitor, like petty thefts, like or those that need to be watched but don't require heavy mitigation strategies. Risks that are highly likely but insignificant. Monitor risk. That is no few things you have to monitor. Fire, like a small fire, not a big fire, like which completely engulfs the organization or completely engulfs the warehouse. A small fire, like which has like created a ruckus in a small part of the organization, a small space in the organization that can be monitored and that can be avoided. So highly likely, but insignificant. So monitor risk will not impact the ability to continue operations. Finally, the risks that are low in both frequency and severity. Very low frequency and severity is also very less. There is not much impact at all. In that case, that is considered as low control risk, can be revisited on a yearly basis to ensure the risk remains low. So this is what risk mapping is all about. The second tool for evaluation of risk is, sorry, have a sore throat, sorry. Risk assessment matrix. A risk assessment matrix is like a tool that allows a single page, uh, single page quick view of the probable risk evaluated in terms of the likelihood or probability of the risk and the severity of the consequences. So likelihood and probability. Likelihood is it may happen, may not happen. Probability is again no like almost like likelihood, but no like it may happen no frequently. So it is made in the form of a simple table. The previous one was a graphical representation, but this is no like in a table representation, where the risks are grouped based on their likelihood and the extent of damages or the kind of consequences. What is the effect of the risk? So that the risk can result in. Making a risk management matrix is the second step in the process of risk management. So risk assessment matrix, no, it would be in a matrix format. Same frequency and severity, that is frequency and the consequences is mapped here, but in a matrix format, whereas in the previous format, it was a graphical representation. Okay, so second step is the process of risk management, that is making the risk management matrix, and it follows the first step of filling up the determined the potential risk. Preparation of risk assessment is more elaborating task and involves determination of task. Why it is more elaborate means you have to know check with each and every department what risks that they can know like face. That there's a possibility for them to face. So overall, every department know like it's overall it's an organization, but the organization cannot know like check each and know like cannot know like list out all the risks now which is going to face. Maybe for top management, they can list out few risks, but each and every departmental heads or managers, they have to come up with, uh, what are all the risks, certain risk or uncertain risk their department can possibly face, in the future. So that is why, it's more elaborating task and involves determining task, gather risk data, determining the probability and the impact level of the risk, understanding consequences, assigning priorities, and developing risk prevention strategies. So first is, determine the probability. So how frequently and the impact level. How much percentage, how much intensity, understanding the consequences. What are all the after effects and assigning priorities. So on that basis, which has to be, given more priority and developing the risk prevention strategies. On the other hand, a risk assessment matrix just provides the project team with a quick view of the risk and the priority with which each of the risk needs to be handled. So it gives a quick idea about to each project or to the each department about so how things has to be done. So this is how the management, there is risk assessment matrix method, it looks like. So this is the frequency and this is the severity. There is no frequency. If the frequency and severity is very high, so it has to be prevented. That is retained. It has to be immediately it has to be taken care of. The frequency is high and the severity is also very high. In that case, it should be completely avoided. If the frequency is low and the severity is very low, retention can be done. The frequency is low and severity is high, again, reduction or insurance that can save the organization. So this is in the matrix model. So those are the two management tools, two tools for evaluating the risk. Now coming to enterprise risk management, ERP. So this is a new concept in risk management. It is though a book has been published in say in, I think in late 1990s. The new concept of ERM that has emerged. So what it is all about? Let's see. It's a process of planning, organizing, leading, and controlling the activities of an organization in order to minimize the effect of risk of an organization's capital and earnings. So to minimize the effect of the risk in the organization capital and earnings. It is a systematic integrated approach to managing all risks facing an organization. So all the risks are listed out and know how to deal with the risks. So it is a systematic and integrated approach. So ERM is a process affected by entities, board of directors, management, and other personnel applied in strategy setting across the enterprise designed to identify potential events that may affect the entity. So it is a discipline. Overall, ERM is a discipline. So by which an organization in any industry assess, controls, exploits, finances, and monitor the risk from all the sources. That is no like each and every department comes with their no like own list of no like the risk which the department is going to face. Top management from their side, they are going to come in with all the list of the risk which they are going to face. In the middle level, all the departmental managers, and in the worker level, the production level, or in the operational level. So all the like the workers and supervisors, they are going to come up with the list of the risk which is they are going to face. That is no departmental wise. So there is no all the sources for the purpose of increasing the organization's short and long-term values to its stakeholders. Nature and features of ER. First thing, it's an ongoing process. It doesn't end with no like just once in the lifetime of the organization, or no like it cannot be done no once in a year, or no like once in 5 years. So it's an ongoing process. No, continuously, no, the risk is no like evaluated, monitored, and controlled. So managed. So it's an ongoing process. Application and strategy setting. So where it applies is no to take no like strategy setting. So what has to be done? What can be no like done to avoid the risk or to minimize the risk, to reduce the risk? Applied across the enterprise. That is every level and unit and entity in the organization, each and every department, each and every zone, each and every activity of the organization. Helps in identifying potential events and affected by people at every level of the organization. So risks in ER. So they have no like ERM applies, that is there's no like few risk or no like applied in ERM. So first one being the credit risk, market risk, underwriting risk, operational risk, and strategic risk. Let's see one by one. So in ERM, various types of risks are evaluated to safeguard organizational performance. First, let's see what is a credit risk. So this arises when borrowers or counterparties fail to meet contractual obligations. Either they will not meet the contractual obligations, that is, they don't stick on to the deadline, they fail to deliver the service, or they fail to deliver the promise, no, whatever they have given, leading to financial losses. It is crucial for financial institutions that provide loans and credit lines requiring careful assessment of a borrower's ability to repay. So while the organization no like is giving no like maybe outsourcing to no like a few of its activities to smaller business units, so they should be aware of no like how potential or these smaller units are, or whether they are no like financing for no other business units, financing for other smaller units, or no financing they are like they are ready to know like lend for no like a few of the activities no like which these smaller organizations are going to perform for the benefit of the bigger organization. So the company has to understand whether those smaller organizations do have the capability, ability to pay back as a no like as a money or no as a money value, either as a money or as a money value. So market risk, it refers to the potential losses due to changes in financial markets. So market is something, no, it refers to the financial markets, such as fluctuations in interest rates, currency exchange rates, and stock prices. This type of risk is significant for organizations with exposure to investments and trading activities. So when this happens, no, like the financial market risk, so the money value keeps on changing. When no organizations are into international business, they trade with no like people or businesses no who are internationally located. In that case, initially when the contract has been made or when a business promise has been made, they would have no agreed to supply few products no on a particular charge. So once the contract is done, once the business talk is done, and once it is documented, when the particular material cost has increased, now the organization cannot increase the total value cost of the products which they have promised to deliver. That cannot be done because no, already no, like it has been mentioned in the contract. So now they cannot no increase the price of the product or increase the price of the total trade. So then no, like there is a financial instability which will be happening. So for the organization who has no offered it, it's a loss to the organization. Say they would have no like promised no like to give a product no at price 5 per unit, considering the raw material for that product no like it may be no like 1 to 2 rupees. But suddenly the raw material, no, after contract, no, after signing the contract, after the business deal is done, now they are no like into production, and now the price of the raw material has no like gone up to 4, 5, or 6 rupees. Now they cannot increase the price of the total trade. That is no the for the product which they have promised to deliver. So there is no something out of the contract. They cannot no like go out of the contract. In that case, no, obviously they have to bear the loss. So there is a risk again. Underwriting risk. So this involves the risk of misjudging an applicant's ability in insurance or loan processes. If risks are underpriced or inaccurately assessed, it can lead to financial losses. In case of insurance, the person who was assessing the risk and no like writing out the compensation for the person who has no like faced the loss. So if that no like the written thing no it's not uh, clearly or no like it's sometimes no like because of misjudgment, the person would have the underwriter would have no like mentioned a particular like a value or a no like money value to something which is different, which is against the policy of the organization. This is sometimes not like most of the times it's not purposefully done because of no miscalculation or because by mistake or because of misjudgment. So this can happen. In that case, no, the organization has to face a underwriting risk. Operational risk. So this emerges from failures in internal processes, systems, or human errors affecting business operations. So all the internal operations, like whatever is happening, like within the organization, whatever failure or whatever, uh, a stoppage or a breakdown is happening in the core internal activities of the business. So that leads to the operational risks. This can be like many things. Like maybe the because of the death of the like CEO or the the investor, the main investor of the company, because of the shareholders withdrawal, they're out of the business, and the business has expected potential investors. Few of the potential investors will be like investing in their business, but like this potential investors like they have changed their decision not to invest in the company. So again, it's a risk. And like the department failures in the department. And why it's a failure? Because of the employees. Like things are not going in accordance with the main business, the core business activity. So because of various reasons, it's a sudden stoppage or breakdown of machineries, which is in the production, or employee turnover, frequent employee turnovers, employee absenteeism, and unskillful labor, like unskilled labor. So they don't know how to work. So they are not like time is getting wasted, energy is getting wasted, and the materials are getting wasted. So all these internal, like problems within the organization, so that can lead to operational risk of the organization. And the last one is strategic risk. So it is linked to poor business decisions or failure to adapt to market shifts, which is like mainly done by the top management. So who's the top management? The founder, the chairman, the CEO, COO, CFO, shareholders. All these people constitute the top management, presidents, vice presidents. So because of poor decisions, business decisions, they believe that like this will work out, but this is not working out. They fail to like speculate whether this particular business will like work out or not before like investing in that. So because of this, making like poor decisions or like uh, what do you say, like wrong decisions. And like they are not ready to adapt to the market shifts. They still go on to like continuing with the same conventional way of like running the business, or conventional way of like selling the products, conventional way of like producing the products, which is not a trend anymore. So in that case, they are failing to adapt to the like the market shifts, so potentially leading to long-term financial or reputational damage. Properly managing strategic risk help organizations stay competitive and aligned with their goals. Yes, Mr. Sayed, have anything to speak?
Yes, ma'am, can you repeat underwriting risk, please?
Underwriting risk is like mostly it happens for insurance companies. So businesses who are like giving out insurances, so and there will be an underwriter in insurance company who values the money, for the person who has been insured. There is like for example, a person has insured himself for like say 1 crore. In case the person is not anymore because of like natural or unnatural death for any reason. So in that case, the compensation money, the insured money has to go to the family. Uh, if the underwriter, clearly, like identifies the reason of the death and like analyzes that, like this death is like something natural, or even if it is unnatural, it is not because of the one of the family member, because of like someone else. So in that case, yes, the like the money can be given to the family. That is the person's deceased person's family. But sometimes, like underwriter too can make like mistakes or misjudgments, especially like when there are like accidental deaths happening. So there is a rule in like rules to be followed by the insurance companies. If a person who has taken insurance uh, dies in an accident, and that person's like because of that person's mistake, maybe like not following the traffic rules, not like like wearing a helmet in case the person is not riding a two-wheeler, don't have an insurance, I mean don't have a like a two-wheeler insurance, don't have a driving license, or like has not followed the traffic rule. There was a red signal but this person like crossed it, and like this person has taken the like one way, which is like restricted, and various reasons. Now, if the person is driving a car, not wearing a seat belt, so these reasons, like because of these reasons, the person has met with an accident and is no more, then the whole insurance amount, like that will not be given to the insured person's family. There will be some reductions. So it is the duty of the underwriter to clearly check all the police records, the, like the, the medical records, to clearly understand what is the reason for the actual loss. So if it is genuine, then they can be, compensation can be given. If it is not genuine, or in case of the deceased person's mistake, then like few amendments has to be done. Family has to be informed about those amendments, why the total insurance money is not given to that person's family. Clear?
Thank you, ma'am.
Okay. So components of ER. So there are various components: internal environment, that is within the organization, objective setting, event here it mentions the risk identification, assessing the risk, and no risk response, how the company, the organization, the employees of the organization is responding to the risk, whether they are not like seriously taking it or not seriously taking it. Control activities, information and communication, whichever like measures are being taken, that has to be communicated with all the employees in the organization, to all the departments. Everyone should be knowing what measures are being taken to avoid those risks. It should be like known to all the employees, so that it should be like a proper and clear and complete information communication has to be like given to all the employees, and finally, monetary. So previously we have seen like risk evaluation tools, and like I mean now it is like risk measurement tools. There are only I think like 2 or 3 tools. Let's see it. The first one is risk adjusted performance measures, which is otherwise called as RAPM. So it is a profitability measures that jointly takes into consideration of the margin or profit produced by businesses and its capital at risk, which is otherwise called CAR, which is capital at risk. Calculation of risk adjusted returns of transactions, trading units and businesses. So that is what RAPM all about. It means performance of a security or investment relative to its risk. It measures returns against the risk taken. So the formula is RAPM is equal to return minus expected loss. So whatever the returns has come minus the expected loss. The loss has not happened, but expected loss, which the company is organization is speculating. So divided by the economic capital. So this is a formula for calculating the RAP. Second one is value at risk. That is VAR. It is a threshold value. You know what is a threshold, right? The to the maximum, like beyond that, like it cannot be controlled. So that is the threshold. Or it cannot be, like managed. So that is a threshold point. So it is a threshold value such that the probability that the mark to market loss on the portfolio over the given time horizon exceeds this value is a given probability level. So it measures the risk of loss on a specific portfolio of financial assets. It is a tool for measuring the market risk. So not to the entire organization. That is the risk is not applicable for the entire organization. If it is a departmental failure, no particular department has faced the risk, it is a risk, which is experienced by the particular department in the organization and not by the entire organization. So that is what value at risk speaks all about. It is a tool to measure banks' risk exposure. It is extensively used in banks and has been strongly supported by banking regulators. The best example is non-payment of loan, dealing with non-payment of loans. That is the banks, like the financial institutions, they keep on lending out loans for business units or for individuals, and they cannot you cannot say that everyone will be repaying the loan on uh, in a corrective measure, in a corrective way. So many defaulters may happen, because of various reasons. Suddenly the corona came, and no one was. I mean, most of the the most of the people who has borrowed loan from the bank were not able to pay back uh, because of they have lost the job. There was no business happening. So how could they be able to pay? The bank was facing many defaulters. They were dealing with many defaulters. So that's why such kind of things may happen. So it is a measure of volatility of firm's banking or trading book, a portfolio containing assets that have a high level of volatility has a higher risk than one containing assets with a lower level of volatility. So maximum loss that can occur with X percentage confidence over a holding period of N days. So this is a formula. So if a daily VAR is stated at 1 lakh, pounds to a 95% confidence level, this means that during the day there is only 5% chance that the loss the next day will be greater than the 1 lakh pounds. That is if 100 people, the bank gives loan for 100 of its customers, it means at least 90 to 92 customers will repay the loan. Again, at least 80 people will repay the loan on the aforesaid date. But 12 people may repay the loan not before the no a particular date, not before that EMI date, but no like it will take some time. They will no like fail to make the payment on time, but somehow no at last they will try to manage and pay back the loan. But the remaining 8 people they can be defaulters. So that is how no this is being calculated. VAR, value at risk. The scope of risk adjusted performance measure. So why no like we are going with an RAPM? So where are all the scopes? So it helps in capital management, helps to determine capital required to support business activity, establish efficiency of capital utilization, because all institutions, no, not only banks, all institutions run with capital. So the capital has to be, like so secured, because like if the capital, when it goes off, like it's very difficult to run the organization. Helps to allocate capital based on returns generated on capital. And the second scope is return management, RM. Focuses on dissection of returns relative to the risk of business segments, helps to analyze the performance at multiple levels. And the third scope is performance linked compensation strategies, PLCS, focuses on use of risk adjusted return on capital as a means for establishing accurate mechanism to align employees' performance and compensation of shareholders' returns. So, what is the no like performance? I mean, no like uh, performance linked compensation. So that is what it focuses all about. And finally is the risk budget. One second, let me know yeah, yes, okay. So risk budgeting, so which is called as RB, covers the use of RAPM techniques to allocate risk and assume risk efficiently within investment portfolios. So no like it's like no like budgeting the budgeting the money for each and every activity or each and every department. They are not like budgeting the risk as well. So like this particular department may face no like a 10% risk. This department may face no like 22% risk. So they are no allocating the risk for budgeting the risk for each and every activity or each and every project or each and every department. So in all these four ways, the RAPM will help out for the organization. So what are the measures? First one is no like Sharp ratio. The second one is information ratio. And the third one is Sortino ratio. Just remember those no like the ratios and what it is all about. So that is more than enough. So Sharp ratio, again, know it's name of the person. So average of the excess return divided by the volatility of the excess return. That is average of the excess return divided by the volatility. Volatility is nothing but no like may come, may not come. Risk side. Risk side is the volatility. So it is mostly used in investment industry, which measures the consistency of performance of portfolio in excess of the risk-free rated risk adjustment terms. So RP minus RF. That is RP is the portfolio return and RF is the risk-free return. The next one is information ratio. It measures the performance of the portfolio relative to a benchmark, that is minimum acceptable return, instead of the risk-free rated risk adjustment terms. So here the formula is RP divided minus RP. So RP we already know it's a portfolio return and RB is benchmark or minimum return. And finally, Sortino ratio. It is a refined version of the Sharpe ratio, which is defined as the average of the active return divided by the downside risk. So it measures whether the portfolio's return, that is not like the overall return for the company, not the risk return, not the volatility, but the overall portfolio return. Say that 92%, which I have mentioned earlier. 92% can be the portfolio return. Baki 8% can be the, like volatility return. So it measures whether the portfolio's return in excess of specified benchmark was sufficient to cover the downside risk. So whatever, no, like from those 92 customers, whatever amount has been collected, So that can somehow compensate the compensate the loss which was created by those 8 customers who has not paid the loan. So whether that can be compensated. So that's how the Sortino ratio will work out. So the Sortino ratio, the formula is RP. RP is again portfolio return minus RB. We know very well RB is the benchmark or minimum return divided by the downside risk ST. So we have now come to the end of the session. There's no risk management. So we will be having a new chapter or new module from next week onwards. So if you have any doubts, oh, we have one more thing. Okay, fine. If you have any doubts, you can ask me. I'll be here for 2 more minutes. So before concluding, I'll just say about a few the techniques, PAR techniques and everything. So approaches to computing value at risk. That is, what are all the approaches to compute the values? We have historical stimulation, model building approach. See, all these these are little extensive calculations. So I don't want to go so extensively because you have to know the overall idea about what is risk management all about. So it's certain and uncertain risk and how companies deal with certain risk, uncertain risk, and know what measures they are taking and how they assess the risk and know what is the frequency, what is severity. So that's how I'm giving an overall idea. I don't want to get deeper into the whole of the subject. Just to mention what are all the approaches I have no mentioned here, but these models, linear model, quadratic model, so it has some extensive calculations and everything. So yeah, we have come to the end. You can stay back and ask questions if you have some, or otherwise we will meet in the next session.
Thank you, ma'am.